Welcome to the TAC Index AI Podcast Weekend Edition. We blend TAC IP data, reports, and charts with the latest news and logistics, focusing especially on air cargo. Today we're diving into something interesting, the global air freight market. Usually this time of year, summer, things quiet down, but it's actually showing surprising strength. So our mission is to unpack the latest TAC Index update and connect that to, well, the bigger picture, tariffs, inflation, all that swirling around. We're looking at the TAC Index air freight market update, plus some recent reports on consumer prices and trade policy chatter.
Yeah, it's definitely bucking the trend, isn't it? The main headline for the week ending July 14th, global air freight rates actually saw some pretty significant gains. Our main index, the Baltic Air Freight Index, BAI0, that was up plus 3.4%, just week on week.
Plus 3.4%, wow.
Right, and it wasn't just one place. We saw gains across the board, really. All the major outbound hubs. It totally defies the usual summer slowdown. The BI0 is now only, negative 3.1% lower than this time last year?
That's surprisingly close.
Exactly. And what's really striking, the market seems, as the report puts it, unperturbed by renewed threats of higher tariffs for stuff coming into the U.S.
Unperturbed, that's the key word, isn't it? Almost like they're just pricing it in already.
It kind of feels that way, like businesses are just getting on with it, maybe planning ahead.
Okay, so that's the big picture. Let's break it down a bit. Region by region, what about Asia? Where's the action?
Well, Asia's definitely contributing to this strength. Out of China, for instance, rates were higher, going both ways to the U.S. and to Europe. Hong Kong, that's the BAI 30 index, gained plus 1.8% week on week. It's now only down negative 6.7% compared to last year.
Okay.
Though, it's worth a quick note. The new BAI spot indices out of Hong Kong, they didn't show much change, so maybe the strength is more in the wider contract market there.
Interesting distinction. And Shanghai?
Shanghai, the BAI 80, saw an even bigger jump, up plus 4.1% week on week. And that leaves it just negative 3.0% below last year, so very close.
Right, almost back to parity year on year.
Pretty much. Elsewhere, Vietnam was a bit mixed to Europe, low to the U.S. India saw rates climb week on week to both Europe and the U.S. So the main story from Asia is definitely this surprising resilience. Most key routes are looking pretty healthy compared to last year.
Okay, so Asia's strong. Is that strength carrying over? Are we seeing the same kind of surprising activity out of Europe and the U.S., considering all their own economic, noise?
You'd think it might be different, but yeah, there's a similar kind of strength, actually. From Europe, rates were mostly flat week on the big lanes to the U.S., China, Japan. But crucially, they stayed ahead year on year on some of those newer lanes we track: Australia, Brazil, Mexico, India, South Africa.
Okay, so some specific lanes holding up well.
Exactly. Frankfurt, the BAI 20, it gained plus 1.5% week on week, mostly driven by increases to the U.S., still down slightly year on year, made it 2.4%. But London's the real standout, the BAI 40. It jumped a massive plus 11.4% week on week.
Whoa, plus 11.4% in 1 week.
Yep. Led by rising transatlantic rates again. And that leaves London way ahead year on year by plus 24.1%.
24%? That's huge. Any idea why London specifically? Pre-tariff stocking, maybe?
It's definitely the number that makes you pause.
Yeah.
That London transatlantic surge is significant. Looking at the global picture, this overall increase when things should be quiet. It really does suggest something's going on. Either businesses are strategically shipping early because of tariff worries, or maybe supply chains are already quietly rerouting. It feels like the market isn't just ignoring the threats, it's like actively adjusting, which is a really important point as we link this to the wider economy.
Right. That's a fascinating picture of resilience in the air freight world. But like you said, connecting it to the broader economy, it seems almost contradictory, doesn't it? The TAC report says unperturbed, but other reports we're seeing talk about rising inflation, tariff fears heating up. How do these pieces fit together? Are they even related?
Yeah, it's a bit of a puzzle. Let's look at that June inflation report. Consumer prices went up 2.7% compared to a year ago. That's up from 2.4% in May. And core inflation, taking out food and energy, that was 2.9%.
Okay, so inflation ticked up. Is that the tariff starting to bite?
Well, that's the big question. It's seen as a potential sign that, yes, companies are maybe starting to pass those tariff costs along.
Yeah.
We saw bigger price increases for things like furniture, toys, clothes, stuff often hit by tariffs.
Right.
But then again, car prices actually fell unexpectedly.
Yeah.
So it's not a completely clear picture.
So prices are up on some tariff-sensitive goods, but down on cars. And I think I saw travel spending soften too.
Exactly.
So maybe it's not just tariffs being passed on. Could it be like a mix? Supply pressure is pushing prices up, but maybe consumers are starting to push back or just can't afford it?
That's precisely the debate happening right now, especially among economists and central bankers.
Okay.
Remember how many companies rushed to build up stock before tariffs hit?
Yeah, the stockpiling effect.
Right. That lets them hold off on raising prices for a while back in the spring. Now, maybe that buffer is running out for some, but it makes things really murky for the Federal Reserve trying to figure out inflation. Fed Chair Powell even sounded a bit more open to rate cuts recently.
And wasn't there something from President Trump about that?
Yeah, he urged the Fed on social media to cut rates by 3 points, saying inflation was very low. So you've got different signals there. And your point about consumers, if tariffs don't lead to lasting inflation, one big reason could be that people just don't have the wherewithal to absorb higher costs, as one report put it.
Makes sense.
We saw hints of that in travel spending, like you mentioned. Hotel prices fell 3.6% in June compared to May. Airline fares dipped slightly, 2.1%. That suggests demand might be softening.
Okay.
But then some economists argue the opposite, that goods inflation rose because some retailers didn't manage to build big stockpiles. So they had no choice but to raise prices on imports now.
So it's complicated. It really depends on the specific company or sector.
Very much so. And adding fuel to this fire are the tariff threats themselves, which are definitely getting louder.
Yeah, what's the latest on that front? It seems to be escalating.
It really is. The Trump administration is talking about 30% levies on goods from Mexico and the EU starting August 1st.
30%? That's a big number.
Huge. And there's even talk of 100% secondary tariffs on Russia related to the Ukraine situation. Analysts are trying to figure out the impact. Goldman Sachs economists estimate U.S. consumers will end up paying about 70% of the direct costs of these tariffs.
Ouch.
And you're hearing companies like Walmart, Ralph Lauren saying publicly they're looking at price increases. Chicago Fed President Austin Goolsbee had a good line on it. He said all these continued tariff threats just make it harder to see where inflation's actually going. It's like throwing more dirt back in the air, was his phrase.
Throwing more dirt in the air. Yeah, that captures the uncertainty well. Okay, let's hop across the Atlantic then. Europe seems to be sailing along okay in the air freight data, but these U.S. tariff threats sound like they could be a massive blow. How bad could it be for the EU?
Oh, it could be really bad. That threatened 30% U.S. tariff on European goods. The EU's own trade chief called it a potential game changer. Said it could wipe out whole chunks of transatlantic commerce, even practically prohibit the trade.
Practically prohibit it? Wow.
Yeah, I mean, the U.S. takes about a fifth of all EU exports, so losing a big chunk of that would be a major economic hit. Barclays economists crunched some numbers. They reckon an average tariff rate of 35%, that includes U.S. tariffs, plus likely retaliation from the EU, could knock 0.7 percentage points off Eurozone output.
0.7 points. That would wipe out most of their growth forecasts, wouldn't it?
Exactly. Most of their already pretty slim growth hopes.
Right.
And that kind of shock would almost certainly force the European Central Bank to cut rates again, maybe down to 1% by early 2026, because inflation would just plummet below their target. There was an earlier German study, too, suggesting tariffs between 20% and 50% could cost Germany's economy over 200 billion euros by 2028.
200 billion euros?
Yeah. That would completely derail plans in Germany, like Chancellor Merz's ideas for tax cuts and infrastructure spending.
So the immediate economic hit is huge, but it sounds like it goes deeper than that, raising some really fundamental questions for Europe long term.
Absolutely.
Well,
It forces a serious rethink of Europe's whole economic model, which has been so reliant on exports. How they generate tax revenue, how do they create jobs, especially with an aging population and the need to spend more on defense. These become much harder questions. And Europe hasn't had a great track record diversifying its trade. Recently, look at the delays with the big EU-Mercosur trade deal with South America.
Right.
Plus, they still have significant internal barriers within the EU itself. The IMF actually estimated those are equivalent to tariffs of like 44% for goods and a whopping 110% for services.
Wow. So internal friction is already high.
Exactly.
Mm.
And here's a final twist. All this uncertainty caused by the trade war, it might actually delay the very interest rate cuts from the U.S. Federal Reserve that President Trump wants, simply because it makes the whole economic outlook so much harder to predict. The ripples just keep spreading.
Okay, so wrapping this up, we've really covered some ground here. From the surprisingly strong air cargo market seemingly just shrugging off these tariff threats, to the signs of inflation picking up in the U.S., maybe partly due to tariffs, maybe not, and then this potentially massive economic storm cloud hanging over Europe if those tariffs actually happen.
Yeah, it's clear how interconnected everything is. Those air freight rates, strong as they are, they don't exist in a vacuum. They're part of this much bigger economic picture being shaped by trade policy, by how much consumers are willing or able to spend. And all the uncertainty from these tariff threats just makes it really tough for central banks, for businesses, for everyone trying to plan ahead. It's forcing adaptation on the fly.
And that brings it back to you, listening. Why track air cargo rates or worry about tariff debates? Well, because it really shows how linked our world is. Think about it, those rising prices for furniture, for toys, clothes we talked about. That's potentially linked directly to these trade discussions. Shifts in air freight can signal changes in how goods get to you. And tariffs, they directly impact the price tag on everything from, a new sofa to maybe even your next trip. It's just a really strong reminder that these big global policies, they have very real, very personal effects on your wallet. All right, that's our deep dive for this weekend. We've unpacked the latest from the TAC index, connected it to the currents of tariffs and inflation. It really shows that even when it's supposed to be the quiet season, the global economy is always buzzing with something fascinating. And here's a final thought to chew on. Maybe this unperturbed air cargo market isn't ignoring the threats at all. Maybe it's quietly signaling a big reorganization. Supply chains adapting before the hammer falls, preparing for a future that, honestly, we're all still trying to figure out. Thanks for joining us. We hope you'll keep thinking about these connections and keep exploring.